Um, hold on. We will find out, I guess, soon. I mean, so this goes on all channels. But anyways, to kick this off, excited to have you, Rex, founder and GP at Cambrian VC, ex-partner at A16z, focused on fintech. So, Rex, thanks for jumping on the show, and excited to go deep on everything that you're doing and what you've done in the past.
Thanks for having me, Joel.
So let's just jump into it. So tell me a little more about kind of where you grew up, what your early education was, and just navigate us through your career and professional path, and then I'll probably stop you in between to dig a little deeper as we go.
Sure. So to start in media race, the most important decision I ever made was to move to the Bay Area and start working in what I think is the world's best tech ecosystem, because the networks here are so good. But it took me a while to figure that out. So long time ago, I actually grew up on a farm in Maryland. I'm one of 5. And so grew up, hoeing corn and selling pumpkins and like doing all that, showing animals at 4-H, that kind of thing. Ended up doing undergrad at Davidson, ended up doing investment banking. If you think about how networks drive your career, a lot of times you'll see that certain universities, college networks have certain connectivity to different employer sectors. And so for Davidson, it's like you've got bio kids going into being doctors, you've got economics kids going into investment banking. And that's what I did. So Bank of America down the street, largest employer of Davidson alums. I ended up there, learned a lot, totally hated it. So I did real estate investment banking, did syndicated finance. I know a lot of people who started out in investment banking, especially investment banking during and post the Great Recession, was just not a particularly interesting place to be. And while I was doing that work, I was observing the work that was starting to happen in fintech on the other coast. And I was like, look, this is way more interesting. So I taught myself to code, drove across the country, and then helped start, and I was just not an employee, but a founder, helped start a direct consumer mortgage company under one of the co-founders of SoFi. Really interesting learning experience. That company failed, but I was now in San Francisco in the kind of right moment and the right place for building a network within a burgeoning fintech within the burgeoning fintech ecosystem. So in the early 2010s, started building community for folks who were building interesting things in fintech. So we would do monthly events in downtown San Francisco. We'd have really interesting speakers come in and talk about what they were building. So we had folks from like Plaid and Deal and other companies come in very early at the pre-seed or seed before anyone knew who they were. And those are the people who've gone on to transform what we think of as being possible within fintech. And so that community that I started was called Cambrian. Today, I'm running my own fund called Cambrian. So Cambrian started as these kind of monthly events downtown San Francisco, grew to the point where I was running monthly events in San Francisco and in New York, doing biannual summits, quarterly job fairs, biannual co-founder matching. I still do the co-founder matching component. And what happened from there is, as I built this really large following, set of network relationships, as well as insights in the ecosystem, I got pulled into investing and advising. And in 2019, I quit my day job to go full-time and actually build a fund. And that's when A16z reached out and they're like, hey, you understand capital markets and finance, having worked as an investment banker, you understand how to build and marshal networks within the fintech ecosystem, and you understand technology because you've worked as a software engineer. So why don't you come and help us build our fintech product? So in 2019, I was the first partner hired externally. We grew that team quite a bit. After 2.5 years, it was either stay for a long time and go and do my own thing. And I think you can see where and why I decided to do my own thing. And I'll tell you, I think most partners who are at large funds, if they could go launch their own thing and felt like they had differentiated brand, network, voice, access, they would do it. And it's the best job in the world. I love it. It's stressful when you get started. Takes time. It's also a really long time commitment, right? Fund 1 is going to be north of 12 years. And you're committing to your LPs, not to do it just for one fund, but to do it for 3 funds. So you're talking about like a 15, 20-year commitment from day zero. And now that I'm 2 years plus into it, I can tell you I'd be very happy doing this job for a very long time.
So I'm an older brother. Tell me a little bit about what your brothers and your parents, reaction was to your career shift. I mean, do all your brothers still work on the farm, or do they all become these investment bankers and venture capitalists? Tell me about that dynamic, because that's quite a change, and that might kind of have different reactions for different family dynamics.
Yeah. So my parents, great parents, very supportive, and they just want all of us kids to go and do things we're interested in and find, compelling. So actually, A lot of my family has ended up in tech. If you think about the employment rate post-Great Recession and certain parts and sectors of the economy, it was pretty high. If you look at tech in San Francisco, it was very low. We're talking like 2.9% when it was like 10% in a lot of other places.
Wow.
So several of my other siblings started in other places, but one of them is now designing the next generation e-bike for Lime. Another one is GM and head of go-to-market at a fintech company, actually, which he moved out here to the Bay Area after removing landmines around the world. Another one started out as a private banker in Switzerland before being early at a health tech startup in the Boston ecosystem. He went into Harvard undergrad, so had a strong network there. And so actually, 4 of us are working in and around the tech ecosystem. And the last one is actually the youngest of the 5 is my sister, Caroline, and she is working to manage ag land. So she went to Cornell, studied agriculture, and her very first job was managing a 35,000 acre farm in Louisiana. 35,000 acres for context. San Francisco is about 7 miles by 7 miles. That's about 49 square miles. That's roughly equivalent to 35,000 acres. So we're talking a really big piece of land. Now what she does is she works for one of the largest private landowners in the country, managing an institutional grade real estate farmland portfolio. And so we basically got 4 folks in tech. We've got one doing ag. Ag, by the way, is a very interesting and growing asset class. If you think about venture, it's kind of a cottage industry that hasn't really formalized or hasn't really started to institutionalize or scale until the last 10 years or so.
Yeah.
Ag is in a similar place where it's a very fragmented market, a lot of family farms. You've got like 2 publicly traded REITs doing ag and then some private funds, but not a lot else. And it really is an asset class that should institutionalize as well. So that's a whole nother can of worms.
Yeah. No, it's amazing. Yeah. I mean, well, congrats to you and your family. And it's just great to see, number one, having a great family dynamic, and then just seeing all of you guys do great things. And I love your focus on fintech, because I think that's just a constantly changing ecosystem and technology layer. So can you unpack the fintech ecosystem as you see it and kind of what you're excited about? I mean, people are talking about embedded finance for a while in the past. One thing that, I want the audience to know too, is you create some great content. I reached out to you because I really enjoyed that interview that you did with Plaid. And I remember, one of my past roles in product, we were exploring Plaid as an integration. So I remember when they were like just getting started, and we talked to some of the early founders, kind of integrating them in for like categorization. So just, can you unpack just the industry and kind of, how it breaks down in your eyes and how we should start looking at it?
Yeah. So let's start really high level, and then we'll kind of do bottoms up. So
that might be a loaded question. So
yeah, if you look very high level, financial services about 7% of GDP. And if you look at the institutions that are doing most of the revenue, a lot of them, like insurers, a lot of them were founded in the 1800s, banks in the early 1900s. So we've seen very little change in a huge enduring part of the economy. And now it is time for things to start changing. And if you look at how much fintech has penetrated financial services to date, it's actually very, very small. We've got a bunch of companies worth 10, 20, $50 billion. Stripe's worth like 50, 60 billion. You've got Deal, which is someone I backed at A16z, worth about 10 billion. You've got Ramp, you've got Rippling, you've got a bunch of other ones. You've got a bunch of really successful companies, one of the most successful categories in venture. Still, if you look at fintech penetration of global financial services revenue, it's something on the order of magnitude of like 2%. So what that means is you've still got 98% of the opportunity remaining. And in the 10 years since fintech got started, we actually now have a lot more founders who actually understand both finance and technology, and they have better infrastructure to build on top of. And you have some underpinning demographic shifts around people just not tolerating terrible products in financial services anymore. And so that's a long way of saying that the market is as big as it was 10 or 15 years ago when fintech first started. The founders are better, the infrastructure is better, and the timing is better. So there's no reason we shouldn't see more companies built or reach scale more quickly who are starting to get more share from incumbents. And so that's very exciting at just a high level. If you drill down a little bit or think about some trends, one thing you want to see is you want to see product innovation, but you also want to see business model innovation. And one thing I'm seeing a lot of now are people building new bundles that are incredibly hard for banks to compete with, because they're bundling things in a way that commoditize their complement, which means a bank can't offer it because the thing being commoditized might be the core driver of their business model. A very simple example of this would be all of these companies that now have high yield accounts. If you think about a bank, their core advantage is cost of capital, and everything else is tied around that bundle, right? They have a bunch of different products, but the core advantage you'll hear people say is like, my cost of capital beats your product every day. Well, guess what's happening? Now, lots of people have high yield accounts that are integrated into a broader product suite, and bank deposit betas, their cost of capital, are going up. We've actually seen $1 trillion of outflows of deposits in the last 12 months. So we're seeing product innovation coupled with a shift in business models, and that creates a lot of opportunity, especially when you got better founders with better infrastructure. So that's just top down, like why I think financial services and fintech, there's still lots of room to run. If you look past that and you start to do some bottoms up stuff. So I run my own fund. I focus on pre-seed and seed investing. 90% of what I do is US B2B fintech. I will do international. I will do consumer. It just so happens that 90% of the most interesting opportunities I tend to find that I am uniquely situated to evaluate are US B2B fintech companies. And when I look at my portfolio, some of whom are now just hitting 2 years old, they're doing very well, scaling very quickly, even in a capital environment that's not as rich as it used to be, which is fine because they're building real products with real value in a capital efficient way. So we just had one company announce their Series A. Anza is building a closed loop wallet for developers. You can think about what they do as offering like a Starbucks wallet as a service. They'll do it both for consumer applications, so like a coffee chain that wants to have a stored value for loyalty and rewards, but they'll also do B2B kind of closed loop payment systems or wallets if you want to do loyalty and rewards for like wholesale to maybe coffee shops or some other thing. Anyways, they've reached a Series A in less than 2 years from founding. If you look at recent Carta data, the number of companies that go from seed to A in 2 years is less than 12%. Companies that go from all the way to A from incorporation in less than 2 years is well inside of that. So if you find really good founders very early, you can see them build and scale interesting enterprises very quickly. And that's super exciting. And one of the things they're doing is, they're helping small merchants take on the card networks, because when you have these reloadable, reusable wallets, you can drive loyalty and rewards, but you also are funding them via ACH, which means you're pulling some of the money out of potential card rails, which have really high fees, especially for low value items. And that's a great team. It's Sophia Goldberg, JT Chu, and they are ex-Adyen and Affirm going and talking about, you have really great operators who have great pedigree, who have unique insights in the market, who therefore are able to build and scale very quickly. There are lots of other great founders in the portfolio, just giving them a call out because they announced their Series A it was a day or two ago.
That's amazing. So you mentioned some of the DNA that you look for, right? Great operators coming from great pedigrees. What else is kind of that magical thing that you're looking for? Because especially pre-seed, it is a little more risky because you're kind of looking at. Can you still hear me? Yeah, there we go.
I can still hear you. Yeah.
Yeah. So what are some of the other things that you're looking for, especially with pre-seed, right? Because you're underwriting the risk of some of the uncertainty, not seeing the traction yet. So you're really, really high conviction looking at the founders. So what has been kind of some of the frameworks that you look at beyond the pedigree, beyond kind of like, hey, they worked at Rippling or they worked.
And I'm going to push back on that. I don't think pre-seed is risky. I think it used to be risky. Sure. I don't think it's risky anymore. I've looked at thousands of deals. And after doing that now, I actually think that if you have the right network, the right ability to identify founders, and you've been looking at the ecosystem for a long time, you realize that great. So why did it used to be risky? It used to be risky because the first generation of fintech founders, they didn't necessarily know how to build something in financial services because they had never done it before. So you mentioned I have a podcast. I've interviewed folks like Ken Lin from Credit Karma, John Stein from Betterment. And when they first got started, they're like, who should my co-founder be? And they're like, they have no idea. They're like, how do I, in the case of Betterment, how do I actually launch a brokerage? It's like, there's no infrastructure to actually build and launch a brokerage on top of an API. And actually then it turns out that Apex comes along, but that's like literally at the same time. So question of like, how do you build the team? How do you build the infrastructure? What should the business model be? How do you scale the team? Who do you raise capital from? Two of the big, multi-stage fintech firms at the time, QED and Ribbit, are one of them like doesn't exist and the other is basically a family office. So you have existential risk on like every aspect of the business. So that's why it
Yeah.
used to be very risky, because you give this person money and you have
Mhm.
no idea if they could build it, hire a team, or raise a follow-on capital.
Sure.
Fast forward 10 or 15 years, all of those things are completely different. You can find really great founders with unique insight into the market. And if you know how to evaluate founder quality, they will be able to build and launch the product. And if you sit around and wait for that to happen, you're
Mhm.
going to end up paying a much, much higher price for something you could have had a high degree of confidence about much earlier. So I think it used to make sense to sit around and
Yeah.
wait for like the A and the B. But
Mhm.
in those intervening 10 or 15 years, those rounds have become much, much more competitive, much, much higher price. And the likelihood, if you identify good founders, of being able to hit those milestones has gone way up. And so that's why I focus on the pre-seed and seed.
Sure.
And when my companies graduate to seed, it's also risky. Like, sure, you might be able to tell that's a great company, but what's risky is you might not be able to win the deal. So
Yeah.
the last company of mine that graduated from pre-seed to seed, they got 7 term sheets before they stopped running their process. So
Mhm.
that's risky too. You might not
Yeah.
be able to invest
Sure.
in the company you want to invest in.
Yeah.
And
Which
so
could be a
I
bigger
don't
risk at
think
times.
if you think about venture, it's source, pick, win,
Mhm.
and then also
Yeah.
support. Sourcing, very important. But for companies, especially as they get, pre-seed,
Mhm.
it can be a little bit hard to see because they might not even be incorporated. It's literally just like
Yeah.
founder's Gmail, and maybe their LinkedIn says they're in stealth, and that's about it. If you get to the seed, usually the previous round has been announced. There are other investors who have kind of, socialized the ecosystem, what they're building, where the company is. So starting at the seed, but certainly by the Series A, it becomes very competitive and very
Mhm.
expensive because the amount of capital in the venture ecosystem. In 2012, about $20 billion was deployed into venture. In 2020, which admittedly was close to the peak of the market, but we're still getting close to back to where that was, $200 billion was deployed in venture in the US. So we're talking about 10x growth in the amount of capital. What that means is it's 10 times more competitive at the Series A than it used to be when you have founders who are better equipped than ever to hit those milestones. And so I really push back on the narrative that pre-seed and
Mhm.
seed and risky. I think what's risky is waiting around to pay up at a later round and then
Yeah.
still losing the deal. And I see
Sure.
that happen all the time with the majority of my companies when they go out for the next round. Now, that's
Yeah,
not
that's a
always
fair
true, right?
comment.
Sometimes it takes a
Yeah.
while to actually build. And so this is one of the
Absolutely.
things I'm trying to educate the market on a little bit is
Mhm.
understanding that actually, if you have great managers, great investors, they can identify great
Mhm.
talent very early. And that's
Yeah.
less risky than trying to give it to multi-stage funds where they pay up, they lose allocation, they
Mhm.
have high reserve ratios where they're buying even more, they're allocating even more money later on. So, and
Yeah, and I
also,
think
I don't think this is novel. If you look at the data and you look at funds that outperform, there is
yeah.
so much research that shows that smaller pre-seed and seed funds outperform, way outperform a
Mhm.
lot of the large managers.
Oh, sure.
And
Yeah,
that's
there's a lot
part
of
of that
data
is
on
just
that.
a math
Mhm.
thing. But I think part of that is also a cyclical thing in that we've demystified the kind of formation stage and what that looks like before. And YC is one of the groups, who gets a lot of credit for this, as well as
Mhm.
lots of other folks who just written content on what it takes to start a company. It used to be this dark art of how do you go from 0 to 1? And now it's not quite a dark art, in part because there are
Sure.
more repeat founders in the ecosystem than there ever were before. And so just the mechanics of what you need to do and how to do it, you don't get stuck on that. Maybe you get stuck on the
Mhm.
fundamental problem of how do you find product market fit, but you're not getting stuck on how do I incorporate? How do I set up payroll? Do I need a hire accountant? How do I put together a pitch deck? How do I run a recruiting process? How do I do those things aren't these existential issues. Who do I raise from? Do I know any investors? Instead, the question is how do I find product market fit? And even there, a lot of times the founders have pretty unique insight into what they're building.
Well, I would say too, I was going to add, I think the fact that you built this community and this close knit network, I think that definitely gives you an edge. I mean, the typical VC may not have those networks and
Yeah.
ecosystems to kind of, open up that talent and access networks. So, kudos to you on
Venture
building
is
that.
it's about access, right? And I think the
It
most
is. Yeah.
access constrained part is still at the pre-seed and seed. Like I
Hmm.
said, as soon as you get to the Series A, there's enough data that people can come in and start using and leveraging that data to try
Yeah.
alternative strategies. So when I was at A16z, one thing we were really, really good at, because we have a really good brand, we're very
Hmm.
founder centric, we have a massive platform team, is we would win deals. If we went in and we
Hmm.
bid on a down the middle Series A, Doesn't matter who else is in the round, we will win the deal. But the problem is people realize this. And so what did they start doing? They started preempting A's before the company was running a process. So did we lose those deals? No, like we didn't want to do those deals. But then what we started finding was all the good deals were getting done before they even got to like what used to be an A. And so the rules of engagement.
It's a pre-sold
changed.
A, pretty much.
Yeah. And this is, Tiger famously did this. SoftBank has done this in various ways. Actually, the kind of original thing people say to criticize A16Z is that we did this like in the early days in the 2010s with our early funds because we were willing to pay up for really great companies. Worked out really well. Coinbase, Airbnb, some other folks. So there are other strategies that make, I think, A's very, very risky for LPs to deploy capital in, even in some of the best managers, because the rules of engagement will change. And I've seen this happen so many times. It's not happening as much right now or in the last 18 months if markets have corrected. But as markets come back, it will start happening again. And I'm already seeing it start to happen now. And you can see this in the data. If you look at Series A valuations, this is from Carta. They use their own proprietary data to look at where median pre-money of Series A's are. It's getting close to, I think it like peaked at 47 million in Q4 of 2021. Q4 of 2023, it's like 43 or 45. So it's within spitting distance of all-time highs. So we have this narrative that venture is falling apart, that fintech is falling apart.
Yeah.
And if you look at the Series A market, fewer deals are getting done and the time between deals has increased, but the price of those deals is actually pretty close to all-time highs, which is not something unpack that a little bit? So I think enough people are talking about.
Yeah, I want to make sure I understand this. So can you distill kind of the average for valuation for pre-seed to seed to Series A for fintech in this ecosystem right now?
So the best way to look at it, and I would just refer to the Carta data for this.
Yeah, absolutely.
I would say, and for seed, and it always depends on how you define it. For Series A right now, median post money. People should go to Peter Walker on LinkedIn. He runs the Carta Data and Insights team. If you subscribe to his newsletter, go to their like state of venture reports. They'll do it either usually on a every half basis, but they'll do some dives on a quarterly basis. You'll see the median pre-money for Series A is around like 44, 45 right now. That's the median number, not an average number. Average tends to skew a little bit higher. For a seed, I think right now it's in the high teens or so. And for pre-seed, it's in the high single digits. And at the pre-seed and seed, that's down about 60% from peak. But for Series A, like we mentioned, it's actually only down maybe 6 or 7% since peak. So there's some yield to capture, especially going in pre-seed, especially if you know what you're doing. Yeah. And the reason for that is you can think of the venture ecosystem kind of like a balloon where the air is the amount of capital trying to get squeezed into a certain sector. And then the size of the balloon at a certain stage, like the valuation, depends on how much air, how much capital is trying to get squeezed in that sector. And what happened is the reason why seed prices went up is multi-stage firms who raise really big funds, like A16Z's recent set of funds, like $6 or $7 billion. When they try to move into seed, that's a huge amount of air capital flowing in, and it inflates valuations. When the market calms down, they tend to pull out of that, and those prices come back down because then you have pre-seed and seed specialists who have smaller funds, who are more price disciplined, who then concentrate on allocating there, and the prices kind of relax. What will happen though is as maybe not, A16Z, my old firm, but as other firms start losing deals, they're going to be tempted, the large multi-stage funds, to start coming down to seed. And that's why I also do a lot of pre-seed and always will, is because even the seed market can kind of get crazy when multi-stage firms start to get involved. But they only do that. That's kind of a counter-cyclical market signal that we're reaching a peak, is when, Sequoia announces ARC, A16Z announces a seed fund. And if you talk to those platforms now, they'll tell you they're like kind of still doing that because they have the programs, but they're not, that's not really the thing they want to concentrate on anymore.
Sure. So going back to access, what advice would you give in terms of community building, like for emerging managers that are trying to build their own community, whether it's in agriculture tech or hydrogen or deep tech? What are some of the things that has worked for you to kind of build this engaged community of investors and co-founders and potential portfolio companies?
I think one is start small, focus on quality, and you'll be an
Yeah.
overnight success in 5 years. So like
Sure.
you have to start with really high quality folks, kind of unique insights, connectivity, and do it consistently. If you do it consistently for a long period of time, it will grow. If instead you focus on trying to grow low quality
Yeah.
interactions and low quality content, it's not going to really work. So high
Yeah.
quality
It's
stuff,
helpful.
high quality individuals, and then do it consistently.
And tell us a little more about your community. So I was looking at the website for a few seconds, but it sounds like it's mostly founders, VCs in the fintech space. Tell me, you said you had some job fairs as well. So we'd love to just have the community be aware of all the great things that you're doing.
Yeah, so I've got the main things I do now are content. So I have a podcast where I interview top founders in fintech as well as operators and investors. So I mentioned, Ken Lin from Credit Karma, John Stein from Betterment. We recently had Eric from Ramp, Ahmad from Mercury, Ty from Unit. We also, the episode published just today is with Keith from Khosla, formerly Founders Fund and formerly Open Door and Square and some other places. So one is content, have some great interviews with folks, and then also LinkedIn, Twitter, that kind of stuff. I used to run these monthly in-person events. Now I run quarterly in-person events where we have a really great founder talk about kind of what's next for their company. So we did an event with Zach Parrott, the CEO and founder of Plaid, at their SF headquarters in downtown San Francisco back in February. We'll probably do 2 or 3 more of those. So like I said, we'll do about an episode a month for the podcast. We'll do about 3 or 4 in-person events where we have a great founder speak about what they're building and do those in San Francisco per year. And then I also focus on high quality, smaller events that are for founders in the portfolio, friends of kind of the closer Cambrian community. I've got 20 plus founders who are all LPs in the fund as well. And I also have a Slack community that has 2,000 fintech founders in it. So if you're listening to this podcast or the stream and you are in San Francisco, you should look out for some of the events. I'll post them on Twitter and on LinkedIn. When they come out, they tend to sell out within like an hour or two. So make sure if you do see something, to act on it quickly. So that's one. If you're in San Francisco, stay tuned for some of our upcoming events. 2 is you can subscribe to our newsletter, which is on the website, cambrianhq.com. That will then share the recordings of those live events as well as the regular podcast episodes. If you're a founder, we have a Slack community. You can find a link to it on the website. Again, we've got about 2,000 fintech founders in that Slack community. It's a great place to go and just ask questions of other founders. Like, I'm integrating with Plaid. I found this issue. Like, have you found this issue? That's not a question that people necessarily ask today, but that's the kind of question they would have asked years ago that you might be asking today around various other kinds of infrastructure providers or things like that. And then I do run the co-founder matching twice a year. We have our first half of 2024 one up and running. About 300 folks have participated. Again, you can find a link to that on the website, cambrianhq.com. If you're looking for a co-founder in fintech, you should go and check that out as well.
Yeah, I went ahead and posted those links too. And, anything else you want me to share, I'll go ahead and share it out. The co-founder matching. So how does that work? So you got 300, do you have like 50-50, like founders and VCs, and it's kind of like speed dating?
No VCs. It's co-founder matching. So it's just founders. It is people
so it's a
with
hotbed
ideas.
for like the pre-seed companies eventually coming to fruition.
That's right. And so actually on occasion, I will also invest in folks who come in through that, but it's mostly an exercise in helping members of the community just go and do interesting things. Not often, but like a good number of people, maybe 7, 8 folks do find, and it's hard for me to track because I don't actually track it, do find co-founders through that each time. But if nothing else, they have a lot of high quality interactions with folks. So it's mutual opt-in. When you participate, you basically will get access to a permission list of other folks who are participating, and then you can reach out via email or LinkedIn, and then it's up to you to connect. So it's a lightweight but efficient way of getting a sense of who else is out there and what kind of ideas they're working on.
Yeah, that's helpful. And I wanted to ask you too, as a fellow creator, because my stuff is pretty lo-fi. I just kind of go live, and I haven't had much time to do a lot of production and editing. But I saw a short form piece of content from Tim Ferriss the other day, just talking about how he works with his podcast guests. A lot of times he makes sure that they can, get a final cut before it goes live. There's a lot of preparation, that happens. Obviously, yours and I preparation. The preparation between you and I has just been pretty off the cuff. and that's just how I've been doing it. But what advice would you give for fund managers, founders that are looking to build a media platform, whether it's YouTube, podcasts? What's kind of your process that's kind of worked for you and worked for your guests?
Yep. So I think the number one thing to do is to ship it. So come up with the kind of content you want to do, a cadence to do it, and then ship it. And be okay if it's not good. I often refer to a piece of content from Ira Glass at This American Life, and he says one of the hardest thing about being a creator is that if you want to be a creator, it's probably because you have some degree of taste, and you have maybe a slightly elevated degree of taste. And the problem is with the first content you produce, it's going to be bad, and you're going to be kind of embarrassed about it, and you're like not going to want to do it, and then you won't do it, and then nothing will ever happen. So you have to first just create content and do it on a regular schedule, and you will get better the more you create. But two, this is the next thing. After you start doing it, you have to constantly be working on your process to make it better. So like right now, you're not doing maybe as much prep work as you could. You're not doing as much post-content production as you could. That's okay. You've gotten started. You're doing it. Now keep doing it and keep making each piece successfully better. And if you do that for 5 years, you'll be an overnight success. So I think the problem is most people don't even get started. And then most people, even if they get started, the ones who tend not to make it better and better over time tend to stop before they put in the time to make it really good anyway. So you have to keep doing it and you have to keep making it better. And so
and then I guess any advice on...
You have to like the content. Like you have to want to do it because there's not going to be an audience at first. There's not going to be like anything that's you can point to like, wow, this like it's really works great. And I like amazing things are happening in my life because of this bad podcast I published. So like, if you're expecting that, you're not going to do it for 5 years. So
I mean, for me, it's been an amazing way for me to learn. I mean, for me,
Yeah.
this is kind of the fastest way for me to learn, because right now, just in 30 minutes, you've unpacked the entire, fintech and, some of SF ecosystem, in an accelerated way. Instead of me reading a bunch of blogs and listening to other podcasts, if I can get an expert to come in and distill it like you did, that's definitely helpful. I've also, just heard from other people, just the utility of just really great thumbnails. There's also like SEO that you can do on YouTube. So any other just kind of best practices for just optimization on the channels or, editing quality. And then have you also looked at short form as well, like taking some of the long form stuff and putting it on like TikTok and Instagram? Obviously you can just get, your head to explode at some point when you just got so many platforms you're thinking about, but any other best practices on those fronts in terms of just improving the content or optimizing it?
Yeah. So the most important thing is still just to ship onto whatever platform you want. I think YouTube is a great platform to optimize for because it's just where all the eyeballs are. So first you have to pick a platform. I think the two best platforms are LinkedIn because everyone's on LinkedIn by default. Twitter is super good. And I love Twitter for what it is, but there are a lot of people who just aren't on Twitter. Especially like newer graduates, et cetera. So like LinkedIn is by default people's professional identities. You should think about having content there. They are starting to do video content, but that is early in its iteration. So I'm not saying that's a great place to do video content. If you want to do podcasts or like audio video, YouTube, I think is the best platform for that. The short form video sites, I do create short form video, but I basically take my long form stuff. I have a team cut it up, push it out there. I don't have to spend that much time on it, but it also just doesn't get that much engagement that I think matters, because I think my audience that I care about engaging with isn't really going to spend as much time or get as much out of these short form video clips on Instagram and TikTok. Could be wrong. But that's been my impression. The stuff that does really well on the really short form video is like talking about, the biggest brand names and the biggest brand name individuals. So it'd be like Musk and Twitter kills Apple. And that can like get a lot of views if you do it right. And you can have a sensational hook, but then, try and deliver quality content afterwards. But it's usually not going to say something that matters a lot to my core audience of like founders who are building things, or at least I haven't figured out a way to do it. So I do short form video content. I haven't found it to be particularly useful. And so I'm more focused on LinkedIn and on YouTube. YouTube is great because it has a huge audience that has a high skew in terms of number of types of different personas that are on it. And the back catalog of stuff will continue to grow over time. I have a bunch of videos that have been around for a long time, terrible production quality, like literally no production quality, and they're still growing linearly, which is great.
Yeah.
So, but the main thing is ship, improve quality over time, pick the platforms that align with your audience. And then, yes, like thumbnails do matter, titles do matter a lot. And so you are going to have to play around in terms of getting those working. And they do matter a lot. Like that's one of the most important things that, folks like Mr. Beast has like 5-6 people or something, and they all like work so hard on getting like the perfect thumbnail.
They're like A/B
right?
testing the thumbnails just to make sure they work. Yeah, so that's super important to him. And then talking about quality, and we both know the same videographer, so definitely that plaid video that you had, it was super crisp looking. So, any advice on how people can work with videographers and kind of get into that art of like just really good production quality? And obviously the lighting is a big thing too. So, any learnings from just kind of getting into more high quality content?
Find a good videographer and pay them money
and have them kind of give you a lot of guidance. Cool. Well, what advice would you give in terms of, we got a couple more minutes, I'll just rapid fire a couple more questions. So what advice would you give to somebody who maybe was a founder or a professional looking to just start their fund one? What are some things that you would tell them to start thinking about?
Well, let's back up and how you even get into the place to be able to start fund one. So depends on where exactly you are in your career, but I think one, you should move to San Francisco, maybe New York. If you want to start a fund, there are basically 2 places in the US where venture happens. San Francisco is where the vast majority of it happens. The only reason I say New York is actually between New York and San Francisco, a lot of the LPs have offices in New York as well, even if most of the venture deals and the venture funds are based here. And what you're doing is you have 2 audiences. You have the founder audience that you're trying to invest into, and you have the LP audience you're trying to raise money from. So you really need to be in one of those 2 ecosystems. Otherwise, you're going to spend so much time on the road traveling, and travel has a high tax on your productivity, and you're not going to build these kind of soft, informal relationships and networks that really matter. So one, move to San Francisco or New York. If you're already like, I've been doing this for 10, 15 years, I have this like massive network, like I don't need to be there, and you feel like why that's true, that might be true. I still think, I think you're right, but you're right in the medium term. It won't matter for the next 3 years. It will matter over the next 10 or 15 years because you will need to continue to build that, and your network will not necessarily atrophy, but it won't grow as fast as it would if you were in the core ecosystems for the thing you're doing, right? So one, and I like to hammer this point home because a lot of the other ones are kind of fuzzy things. They're fuzzy ideas, right? They're like, do this, don't do that. This is a very concrete thing. You can either say, I am doing it or I am not doing it, right? Whereas all the other bits of advice I can give you, like maybe they matter more along some, like if you were to stack rank the types of things you need to be doing, but it's fuzzy to measure yourself as to whether or not you've done it and done it well. So that's one, is just be in ecosystems where it's happening. And then 2, and this is where it's a little bit of a longer story, and maybe whoever's listening, they're in a different part of this journey, but I think like, let's go all the way back to undergrad. So if you're in undergrad and you're getting your first job, move to the Bay Area. 2, the next thing you want to do is join a mid-sized company with growth. Right now, that's any company that's raised a Series B within the last 12 or 18 months. Why a Series B and why the last 12 to 18 months? Well, it used to be that 2 years ago, everyone was raising Series Bs. They're very expensive, and it was very hard to tell, are these companies raising money good companies or bad companies? Last 12 to 18 months, the market has turned. Series Bs are very few and far between. And so that means the companies that are raising them in a down market are default very good companies. So another way of saying that is the signal to noise ratio for Series Bs for now, higher than it's ever been. Easy to identify mid-sized companies with growth. So that's why you can look for Series B companies now in a way that's unique to this moment in time. And then 2, always what you should be trying to do as early in your career as possible, but even later, if you haven't done it already, is join a mid-sized company with growth. Why does that matter? And that's true no matter the market cycle. It's just right now we're in a unique point in the market cycle where I think it's easier than usual to identify those companies. Unfortunately, there's a smaller number of those companies than there are, but there's less noise. So it's kind of a, a trade-off there. So why join a mid-sized company with growth? If you join a mid-sized company with growth, maybe they've got 30, 40, 60 people. They went in the last year from 2.5, 3 million to 9 million in revenue. They grew 3x year over year. They just got a brand name investor to lead their Series B. They're now growing the organization. They need to hire more in sales. They need to hire more in product. They need to hire more in engineering. The people who are there are going to get promoted or manage teams or manage. When you come in and you say, hey, I'm going to do this thing, no one's like, no, don't do that thing. Like, you're going to take my thing. They're like, please, God, thank you. Do this thing for me. I have too much to do. And then as the company continues to scale, and Series B companies are supposed to have repeatability of go-to-market. So they should be somewhat de-risked, at least for the next few years in terms of continuing to grow. So you should get pulled along in your career progression to be able to do very interesting work at a company that's growing, and therefore having a career or a job scope that's growing while you're at that company. Then what happens is, for the next time you go out and look for a job, someone's going to say, hey, I want to hire someone who's like been in a company that's another mid-sized company growth, or that's like later stage, can be like, we're growing really well. I want to hire someone who's been in a company that's done really well and has scaled this thing. And you're like, oh, I've done that because like I happen to be at this other company. So you get to have the career story that you help scale something, and then you get to borrow the brand equity of that company. And then that means you can land in another good job at another fast growing company. What's hard is if you come to the Bay Area, you work for one pre-seed or seed company, it fails, and then you go and work for another one and it fails. And then you're like, I don't know. Now I invest in pre-seed and seed companies. I think people should go and work for them. And I think those can actually be the most exciting, interesting, and like validating career experiences. But you should do it because you're a missionary and you believe in the founder and you believe in the company so much that you're willing to take that career risk. And then even if it fails, you'll be like, you know what? I had a blast. We got to build something that was super interesting. That was my experience at the failed direct consumer mortgage company. Still worked out okay. So I still think you can go earlier, but you have to have you have to be committed to the mission of the company. Series B, I don't think it's great to be like entirely mercenary, because I think you're just going to end up being unhappy. But if you were to be more mercenary, like that's the stage joint. So, okay, now we're starting to talk about how do you get into venture. That's very long answer your question. Now you're at your second mid-sized company with growth. You've like led 2 growing organizations. Some of your friends from the first company have left. They started starting companies. Some of the folks from your second company are also leaving, starting to start companies. They want you as an advisor because you've like helped scale things in the market, and the company they're starting is somewhat related to the company you guys worked at together. And then you're also going to write them an angel check. And then you do that for 2 or 3 years. And all of a sudden you've written like 10 angel checks. You're like advising a couple of companies, and you're like, oh, maybe I should go and do venture, because like I really like advising. I really like, backing people. I have this network. And then you can start networking very hard with the most junior level folks at venture firms who've been hired in the last 6 months, and sharing deal flow with them. Why do you network with the most junior person? Because the junior person doesn't have a network yet, or their network is not like kind of fully booked out. If you go to the senior people, they're overbooked. They don't want to talk to you. You go to the junior people, they're happy to talk to you. You do that for another 2 years. Now you have a network of folks at venture firms, and you know who's hiring, which firms are good firms to work for, which ones you like, which ones you don't like. You have a bigger angel portfolio. You've maybe advised more companies. So again, this is kind of like the 5-year plan of how to break into venture. But that's the best plan, is move to the Bay Area, join one mid-sized company with growth, go to another one, angel advise, invest, network with investors, and then maybe in 5 years, you'll be in a position to join a good venture firm. By the way, you only want to work for good venture firms, because bad venture firms return less than the money that's invested in them. So you are way better off to take 5 years to land a good job than to try and take any job at any firm early. And so that's, I don't always remember to say that, but that's very important. Also, the best outcome, you decide you don't want to be a venture investor, because there's a lot about the job that you might not like. And if you've learned that you really like building companies, you should do that instead. And that's probably more fulfilling and interesting than like going and working at a venture fund. So that's the other thing, is you will have more career optionality in terms of what you could do if you take this path. And it's probably the best path to actually end up in venture anyways.
No, that's helpful. And I think just, to your point of joining a bigger firm, you can definitely, do a lot of storytelling in terms of that track record and kind of the capital that you were involved in deploying. So I think that's definitely good stuff to kind of talk about. A lot of times LPs talk about like a synthetic track record. So like kind of that track record that you built over time that you can kind of get some attribution for when you're kind of building your own firm and kind of flowing into that.
Yeah, and
But,
actually,
hey,
your
man,
question was how do you start a fund? So there, it's if you have like enough pedigree and a big enough track record from your angel investments, that's might be enough to do a fund one. It's gonna be pretty hard.
Yeah.
Ideally, you should go and work for a firm and build like a real track record, see how a firm actually operates, and then leave that firm and start your own. So
I think also the
again,
structure,
takes,
it
took me about 10 years to get to where I am, right? Like that's,
Yeah.
and it was not linear. It was also not, it was not what I set out with. It's not like I started Cambrian. I'm like, here's my secret plan in 10 years. I'm gonna do this thing. It's like, I did things. I was interested in them. They grew, they created some options. And then I chose the options I was most excited about. And then this was the thing that kind of became clear to me that I should be doing.
Yeah. And I was going to say too, the advantage of kind of working at a bigger firm, or at least a firm that has some processes, some of that structure and process you may adopt, or just kind of make an iteration of when you build your own firm as well, which if you didn't have that, you were just doing angel investments, you got to kind of figure it out on your own or seek mentors. But hey, man, this was amazing. Rex, thanks so much. I mean, this is why I do this podcast, because in 45 minutes, I feel like I become much smarter. So thanks for just catching us all up on your insights. And I will hopefully see you in San Francisco at our summit next month.
Sounds good. All right. See you around,
Awesome.
Joel.
Thank you. Appreciate it, Rex. Have a good one.
Cheers.
Bye.